Now, welcome to this second episode on the series Bond Valuation and Investing. Here we'll be mainly covering interest rate term structure and yield curve. Following areas will be covered in details in this presentation. What are interest rate term structure and yield curve? What are the spot rate and forward rate of an yield curve? Calculation methods of spot rate and forward rate. Theories explaining the shape of the yield curve. Sovereign yield curve and factors influencing its shape. Different observable shapes of the yield curve. Factors driving the shape of the yield curve. What is the yield spread? Factors driving the yield spread of the corporate bonds. I am Aninda Datta, the presenter. Now, what is term structure of interest rate? Term structure of interest rate is the relationship between interest rate or bond yield and different terms of the maturities. The graphical representation of the term structure is called yield curve. The yield curve is a graph which depicts how the yield on debt instrument varies as a function of the years to maturity. A properly constructed yield curve should be based on a set of securities which have different lengths of time to maturity, and all yields should be calculated at the same period of time, at the same point of time. All securities measured in a yield curve should have similar credit rating to filter out the effect of the yield differentials caused by varying credit risk. The yield curve plots the spot rates on y-axis and the time to maturity on x-axis. The spot rates indicate the rate for a certain maturity prevailing at the time zero. So spot rates are also called zero rates. The spot rates / zero rates are indicated by the symbol 0t, means the rate prevailing at time t for the period, the rate prevailing at time 0 for t period maturity. Example R03 equal to 4% means the market yield prevailing at time equal to 0 for 3 years maturity is 4%. Another important concept for term structure of interest rate is the forward rate. Forward interest rate refers to future yields on the bond starting from a future date and maturing at a future date. F2, 3 of 6% indicates that a loan starting from year 2 and maturing on year 3 carries an interest rate of 6%. Now the forward rates are implied by two consecutive spot rates of the yield curve. The forward rates are not directly visible on the yield curve but are calculated from the spot rates. Now, considering continuous compounding, the relationship between spot rate and forward rate is given by this formula. Here the exponential method is used as the compounding method is continuous. Solving this by taking natural logarithm on both sides gives the following, that is forward rate equal to R2 into T2 minus RT1 into T1 divided by T2 minus T1. F is the forward rate 1, 2. R1 is the spot rate 0, 1 and R2 is the spot rate 0, 2. Now the Excel file shows the forward rates are also the Excel file shows the forward rate calculation from the spot rates. Now this graph shows the spot rates and forward rates for a bond where x-axis contains the years to maturity and the y-axis contains the rates. Just see the forward rates are also increasing as the spot rates are increasing. Yellow curve is the spot rate and blue curve is the forward rate. Now, just as the yellow curve, that is the spot rate curve, flatten out, the blue curve, that is the forward rate, falls. The above method is based on no arbitration possible between the spot rates and the forward rates. If one rate is lower, then there would be less buyer for that bond, thus pushing down the price and increasing the rate. Now, instead of using continuous compounding, discrete compounding rates could be used for the same forward rate calculation by this formula. Now, shape of the yield curve varies a lot, and what are the theories available to explain the shape of the yield curve? Expectation theory states that long-term yield of a financial instrument is the average of the short-term yields that are expected to occur over the life of the instrument. Example, the investor earns the same amount of interest by investing in 2 consecutive 1-year bonds versus investing in 1 2-year bond today. That is R01 into F12 equal to R02 to the power 2. This theory states that yields of different maturities move together as long as long-term yields are perfectly correlated to short-term yields. Market segmentation theory states that interest rate for short-term, medium and long-term should be considered separately, and there should be no relationship for market for bonds with different maturity lengths. Market segmentation theory suggests that supply and demand at each term will create a term structure. Thus, it fails to explain why all segments of yield curve tend to move together. Liquidity premium theory. This is a combination of the first 2 theories. It states that long-term interest is the average of short-term interest rates, plus investors prefer less risky, more liquid assets, and long-term rates are higher than the short-term rates because they include a premium for risk. Now, the general belief is that long-term bond prices are more sensitive to the interest rate fluctuations, so higher yield is demanded by the investors. Now, what are the factors influencing sovereign yield curves? That is the yield on bonds issued in local currency. Generally, short end of the yield curve is influenced by liquidity and policy interest rates set by a central bank, whereas medium to long end of the curve is influenced by expectations about inflation and economic growth. Now, inflation. Higher the inflation expectations about the future, higher is the interest rate. Economic growth. Higher the economic growth expectations about the future, higher is the interest rate. The policy interest rate. The policy interest rate influences the short end of the curve. Now, liquidity risk. Higher the liquidity risk pushes up the yield for the period where liquidity risk is expected. Term risk. As longer maturity bonds are exposed to higher interest rate and default risk, so higher term usually carries higher yield. Now, this is the US Treasury yield curve on 16th of August. The short-term yields are higher because the policy rates have been set at much higher level at around 5.2 to 5.45%, but the yield curve is inverted as it is downward sloping. An inverted yield curve, the short end reflects the Fed's funds rate of 5.25 to 5.5%. So generally all the money market instruments yield is around 5 to 5.5%. The yield curve is inverted as the market expects a series of rate cuts due to inflation falling towards a target of 2%. During the rate hike cycle, the medium to long end of the curve never moved up to the same extent as market never expected the inflation and economic growth to sustain for long. Such an inverted yield curve is deemed by many to be an indicator of the upcoming recession, as curve discounts fall in inflation growth and interest rate cuts by the central bank. Now, the upward sloping yield curve is the natural shape of the yield curve as the long-term interest rate expectations are higher due to higher risk of inflation and default. Now, this is the Indian yield curve as on 19th August 2024. This is an upward sloping yield curve, but the magnitude of the upward slope is quite low. And the other two curves show the yield curves. One shows 1 month ago and another shows 6 months ago. The long end of the curves have remained the same, only the short end has fallen a bit. As the Indian government yield curve is upward sloping, but magnitude of slope is not much. The 10-year to 2-year spread is just around positive 1%. The market does not expect a rate cut by the RBI in near future. A stiff upward slope curve underlines expectations of much higher inflation interest rate in the future or policy rate cut by the central bank. On policy rate cut, the short end of the curve goes down, leading to more upward sloping curve. However, the Indian yield curve is more flattish. So the inflation and the GDP growth are expected to remain around same in the medium to long term. An upward sloping curve could start turning flattish if the central bank starts hiking rate, as the short end of the curve starts moving upward. The upward slope of the yield curve would start steepening if the central bank starts cutting rate as the short end of the curve comes down. The slope of the curve changes with change in the outlook for the inflation and the economic growth. Now, what is a flat yield curve? A flat yield curve occurs when the short-term yields are similar to long-term yields. It is observed when the yield curve is transitioning between a normal and inverted shape or vice versa. Now, this is the shape of a flattish yield curve. From here onwards, the yield curve is completely flat. So when the central bank makes sharp hikes in short-term policy rates, the short end of the curve rises more than the long end, thus flattening the yield curve. In a situation of inverted curve, if there is a fall in inflation and growth, the central bank starts cutting policy rate. The fall in short-term rate is more than the fall in the long-term rates, thus flattening the curve. Now, the flat curve could also be caused temporarily where the demand for long-dated bonds exceeds the supply, thus pushing up the price and pushing down the yield. Now, the sovereign yield curve influences the yield on all other bonds issued in a country. As the sovereign bonds carry minimum default risk compared to all other bonds, so the treasury yield acts as a floor for all other bonds. That is, the yields on other bonds are higher than the sovereign yield of similar maturity. A bond credit spread reflects the difference in the yield of a corporate bond and a government bond of similar maturity. Now, the credit spread of bond varies based on their credit quality. Now, the yield spread reflects the additional yield required by investors to be compensated for additional risk. So the spread is influenced by many factors which influence the credit quality. Credit spreads are not static, as they tighten and expand over time depending on the following. Broad economic conditions. Yield spreads widen in a weak economy and tend to narrow in a strong economy, as during low growth or recession, funds flow to high credit quality bonds from low credit quality bonds. Credit cycle. Yield spreads widen in a weakening credit cycle and narrows during improving credit cycle. Financial markets performance. Yield spread widens during a weak financial markets and narrows during the strong financial markets. Supply and demands for bonds of specific credit quality. Higher supply than demand reduces the price of bonds, leading to increase in yield and spread, whereas higher demand than supply increases the price, thus reducing the yield and the spread. As widening spread means increasing yield and reducing price, so buying low credit quality bonds should be avoided during the weak economic cycle. However, at the bottom of the economic cycle, when the yields of high risk bonds are high, one may buy such bonds whenever the economic turnaround is visible. Now let's examine US investment grade and high yield bond spread since 2015. Now this is the US high yield bond spread since 2015. See, there are such huge fluctuations here. Historically, there have been huge fluctuations, and this is at a very low level historically, given the historical figures. And this is the US investment grade bond spread. Here the fluctuations are much less. The variations are much less, the spread is much less. So here the current spread is near about the mean spread of the last 10 years. The bond spread in high yield is at very low percentile at the present. If Fed cuts the rate, there would be increase in high yield bond prices due to the duration effect. However, if economy weakens, there is high likelihood of increase in spread of higher magnitude than the rate cut. So price fall due to spread expansion will be more than price gain due to rate cut. There is not much scope for spread increase for investment grade bonds based on the historical spread. But price gain due to rate cut is bound to occur. Thus, it is risky buying high yield bonds at such a low spread percentile, so safer to buy investment grade bonds now. So this concludes this presentation. The series will continue with new areas of bond investing. Thanks for watching.